The king is consolidating their power. The first wave of the streaming wars seems to have come to an armistice, and Netflix is standing atop the ash heap. The undisputed leader in both total subscribers and sheer volume of content, Netflix reported yet another stellar quarter of earnings. Let's break those earnings down and assess why Netflix truly is the only media company worth our investing consideration. Welcome to The Quality Investor. The streaming wars kicked off in 2019 with the launch of Disney+, and it mainly consisted of a race for content, talent, and subscribers. And this race has ballooned content spending in order to secure that coveted subscriber revenue. And therein lies the key. In order to attract subscribers, these streamers need a content library worthy of the viewer's attention. And content is expensive. I said Disney Plus kicked off the wars, and that is because Disney spent billions on content. In 2020, Disney dropped $28.6 billion on content, and that number got as high as $33 billion in 2022. In 2025, Disney is looking to spend about $24 billion. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So why is all of this relevant? Well, I want to establish a baseline to measure Netflix against. Over the years, Wall Street has been hyper-focused on subscriber count when it comes to the streamers. And that is what Disney focused on as well. Netflix was already well established heading into the 2020s. By the end of 2019, Netflix had 167.1 million subs. Disney, however, had a little over 26 million subs at the end of 2019. Disney rapidly grew that subscriber base, reaching 164.2 million subs by 2022. They did so with the aforementioned content spend, but also by offering discounted pricing and promotions for their service. A monthly subscription for Disney Plus was only $7 back in 2020. Now, Disney has some deep pockets, but it was trying to become competitive with Netflix as fast as possible. Netflix, however, has since demonstrated why they are the king of streaming and have established their brand as the premier brand. This is one part of their economic moat. Now, let's do some back of the napkin math. Take Disney's 2020 content spend of $28.6 billion and spread that over a subscriber count of 73.7 million throughout 2020. That is roughly $388 of content spend per subscriber. With a price of $7 a month, Disney was only pulling in $84 per year, or $80 with the annual upfront discount. That is a $300 loss per subscriber. Netflix, on the other hand, spent $12.5 billion on content in 2020, less than half of Disney. Netflix also had 203.66 million subscribers, nearly 3 times what Disney had. Netflix's content cost per subscriber? A paltry $61 of content per sub. Netflix had tiered subscriptions in 2020, but using their mid-tier plan of $13 monthly, that works out to $156 annually, or $95 of gross profit per sub. Netflix was making more in gross profit per sub than Disney was charging per sub annually. Today, Netflix is even more dominant. While Disney has had an erratic subscriber count due to the loss of certain streaming rights, price hikes, profitability still matters, and other factors, they have 124.6 million as of now. Netflix has seen their subscriber count explode, now at 301.6 million. With Disney set to spend $24 billion on content in 2025, that is about $193 of content cost per sub, whereas Netflix is set to spend about $18.6 billion on content, or about $62 of content per sub. The story is similar for other streamers out there. While Netflix doesn't spend the least, their scale gives them a huge cost advantage over everyone else. meaning Netflix is the most profitable. I've linked to some sources detailing the subscriber counts and content spend. NBC Peacock has the worst cost structure, by the way, coming in at about $661 of content cost per sub. So, Netflix currently sits atop the streaming mountain. Aside from being very efficient with their content spend, they have something else: pricing power. Their mid-tier plan today is $18 a month or $216 annually. That puts their gross profit per sub at around $154, up from the $95 I mentioned earlier for 2020. Netflix has seen subscriber growth, profit margin growth, and they have the deepest content library in streaming. Their Q2 2025 earnings yet again showed why Netflix is king. Let's dive into these earnings and also look at what a nice buy price would be for this streaming Goliath. Netflix is trading a little bit down today, just under 5% down, trading at $1,215.23. Year to date, however, they are on quite a tear still, up over 37%. So the market wasn't too pleased with this earnings report, despite strong growth and raising their guidance. So the question is, why? Why is the market a little bit upset today about what Netflix did? In my view, the answer is a little bit short-sighted for why they're down. Netflix earnings soar past expectations. How a weak dollar helped boost results. The article starts out, Netflix beat expectations for its second quarter earnings results Thursday afternoon, but much of the strength came from a weakened US dollar. It goes on to say that they reported $7.19 earnings per share, ahead of Wall Street's $7.08. Revenue was at $11.1 billion, above expectations of $11.06 billion, which is also 16% year-over-year revenue growth. Operating margin also exceeded expectations, and even the company's projection for $6.87 a share in the third quarter is better than analyst estimates at $6.69 a share in revenue as well, at $11.56 billion versus an expectation of $11.28 billion for the third quarter. So they beat both on the top and bottom line and raised their guidance, but it says the company explained in a shareholder letter that all these beats came from a weaker US dollar in the second quarter. In 2024, Netflix got 59% of its sales from abroad, which are subject to the whims of exchange rates. In the second quarter, 56% of revenue came from outside of North America. So what they're saying here is that when the dollar is weakened, Netflix earned foreign revenue in a strengthening currency like the euro, but it books that revenue in a weakening dollar. And then the analyst here from investing.com, Thomas Montero, says this is arguably the core theme of the report. Given the highly favorable FX backdrop for a company with such a globally diversified revenue base, the market was expecting a much stronger upward revision to full-year guidance. That didn't quite materialize, despite another standout quarter from the streaming giant. And to me, that's a silly reason for the drop that we're seeing today in the market. They were expecting more of a guidance. Why didn't Wall Street raise their expectations then? But it doesn't matter. The point is, the market was looking for something to be unhappy with Netflix. Netflix is trading at quite a premium right now. All the core parts of the business for Netflix had strong growth in Q2. There was just an exchange rate issue, and the market didn't like it. So right now, Netflix is down about 5%. Looking here at the results for Q2 2025, we can see they are quite impressive. $11.08 billion in revenue, which represents 16% growth. But look at this margin expansion, 34.1% operating margin. Compare that with Q2 of 2024 at 27.2% operating margin. That's a 690 basis point increase. Massive margin expansion. And the reason for that is what I pointed out earlier in the introduction. Netflix has massive operating leverage. Netflix has done a very good job of preventing their content spend from getting out of control. It's increasing, but it's increasing at a rate far less than what they're able to raise their prices and grow their membership by. Meaning every new subscriber lowers that content spend per sub dollar amount, giving them more gross profit. A very profitable business due to the scale and their ability to grow their market share and leverage their pricing power. That is the definition of a company with a wide economic moat. And you can see the fruit of that in their massive free cash flow growth over the last 4 quarters. $1.2 billion in Q2 of 2024. Today, $1 billion more in $2.2 billion. in Q2 of 2025. And while the market is so focused on this FX impact, one thing that we also see here in the earnings report is that member growth was ahead of our forecast, although it did occur late in the quarter, which limited the impact on the Q2 revenue. But the point is they're growing their membership. And not only that, they have the ability to raise the prices for their subscription tiers. It's a very well-run business, and they had another outstanding quarter. And looking at the cash flow statement, we see additions to content assets. So far through June 30th, Netflix has spent about $8.4 billion when you combine the $7.4 billion here with the $0.6 billion. A little under half of what they're projecting to spend in 2025 of $18 billion. But they also have a large amortization expense here of $7.6 billion. It's a non-cash expense, which is why it's added back into the cash flow from operating activities. And because they have such a capital-light structure from the rest of the business for their property and equipment, Netflix generates a lot of extra cash flow. And you can see that here in some of their fundamental metrics here. You can see their very consistent growth in their revenue, gross profit, and operating income. But if we look at the free cash flow here, like I said, they're very capital light, and they just became consistently profitable in free cash flow, at least, back in fiscal year 2022, and you can see that number has exploded since. But the real strength of Netflix's business is, like I said, it's in their operating model, and you can see that reflected here in the growth of their margins, massive margin expansion over the last 10 years. And as they add more subscribers and remain disciplined in their content spend, their margins are set to explode. I've seen some estimates upwards of 50% over the next 5 to 10 years for operating margin, given their current growth trajectories. And that also means their ROIC has steadily risen over the past 10 years. So Netflix has become a very well-run, very efficiently run business that's demonstrating its economic moat with its pricing power and its operating leverage. And now we're starting to see the real benefits in the free cash flow turning up. These are the growth projections I have for Netflix over the next 10 years. You can see on a trailing 12 basis, the revenue has grown at nearly 15%, but on a bear case, I have their revenue growing over the next 10 years at 11.4%, up to 15% on the bull case, and operating margins expanding to 35% by year 10 for the bear case, up to 45% for the bull case. I'm being a little bit more conservative than the 50% operating margin projections I saw in some analyst estimates, and that will ultimately lead to a very nice free cash flow generation, 26.9% free cash flow margin by year 10 for the bear case, up to 44% free cash flow margin for the bull case. And that is also contingent on them continually increasing their free cash flow conversion, which they have been doing consistently over the last 5 to 10 years. Right now, Netflix is trading at $1,213.12, which gives them a PE ratio of 51.7, right in line with their 5-year average. Their forward PE stands at 47.4. A bit higher than their 5-year, but still lower than their 10-year. And the market right now is pricing in free cash flow growth of nearly 20%. On my own base case DCF, I have free cash flow growth at 22%. So I'm actually a bit more optimistic than the market at this point. On a bear case, I have a discounted cash flow price of $913.95 up to a bull price of $1,938.04. Netflix does not pay a dividend, and I don't have an exit multiple for Netflix right now. Some of the competitors that I'm using, like Paramount Global and Warner Brothers Discovery, are actually not even profitable. Thus, they don't have a PE ratio to even compare. And my other competitor for them, Walt Disney, would just skew the results. So on a bear case, they do have a downside of about 25%, but an upside of about 60% on the bull case. The bull case is really accounting for the fact that they're going to be the biggest winner of streaming over the next decade, and that their content library will only get better, especially as they start adding more and more live events, of which they'll also generate a significant amount of ad revenue. Right now, it's immaterial to the business, their ad revenue. That's set at a buy price right now of $1,405.96, but with a 20% margin of safety, it's a buy price of $1,124.77, or a forward PE of 43.9. So I would like to see it come down below $1,125 before I'm comfortable adding this stock to my portfolio. This has been a watch list stock for a while. Everything about this business seems to be improving, but Netflix is also a volatile stock, and we could get a nice drawdown under the right circumstances because it has been running up very high over the last year. So we'll see what happens with Netflix. I do think it's a really good business, and I do think they're going to be the primary winner over the next decade from the streaming wars, and that's going to really explode their free cash flow. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.